Welcome to Academic Gain Tutorials. In this video, we will look into the differences between equity market and fixed income market. Equity markets involve the purchases and sales of stocks conducted on regular trading exchanges. Investors obtain partial ownership of corporations in equity markets, while bonds are solely interest-earning investments. The Nasdaq and the New York Stock Exchange, NYSE, are among the best-known equity markets. On the other hand, the fixed income market is more commonly referred to as the debt securities market or the bond market. It consists of bond securities issued by the federal government, corporate bonds, municipal bonds, and mortgage debt instruments. The bond market is referred to as a capital market since it provides capital financing for long-term investments. So, let's look into the basic differences between equity market and fixed income market in a tabular form. Difference number 1. The equity market is a platform for buying and selling stocks and stock-related mutual funds, whereas the fixed income market is a platform for trading securities like bonds that guarantee fixed income. Number 2. In the equity market, issuers are mainly corporates, whereas in the fixed income market, issuers are mainly governments, municipalities, and financial institutions. Number 3. The equity market carries a higher level of risk, whereas the fixed income market carries relatively lower risk. Number 4. Investments in the equity market provide higher potential returns, whereas investments in the fixed income market provide lower but more stable returns. Number 5. In case of bankruptcy, equity investors are the last to claim company assets, whereas fixed income investors have the first claim on assets. Number 6. Investors in the equity market may have voting rights and ownership, whereas investors in the fixed income market do not have voting rights or ownership. Number 7. Equity market returns depend on company profits, dividends, and stock appreciation, whereas fixed income market returns come in the form of regular coupon payments and principal repayment. Number 8. The equity market is generally more suitable for long-term wealth creation, whereas the fixed income market is more suitable for generating steady income and preserving capital. Number 9. Equity market values are volatile and influenced by company performance and market sentiment, whereas fixed income values are relatively stable and mainly influenced by interest rates and credit risk. And difference number 10. The equity market includes instruments like common stock and preferred stock, whereas the fixed income market includes instruments like corporate bonds, government bonds, municipal bonds, and zero-coupon bonds. So, these are the differences between equity market and fixed income market. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.